Welcome back to the Commodities Institute podcast. I am your host, Emily Costa, and I'm so glad you have tuned in today, Thursday, January 29th, 2026. We are navigating a truly remarkable moment in the global markets. If you have been watching your screens over the last 48 hours, you know that the term volatility does not quite capture the sheer scale of the movements we are seeing across the board. From safe haven rushes to weather-induced spikes, there is a lot to unpack, so let us dive straight into the heart of the action. We begin today on the water, where the dry freight market is signalling a cautious but steady climb. The Baltic Dry Index, which many of you track as a primary health check for global trade, moved up 17 points yesterday to reach 2,016 points. While that might seem like a modest gain in isolation, it comes at a time when shipping lanes are under immense pressure. We are hearing reports that a full return to the Red Sea route remains on hold after renewed threats from Houthi rebels. This geopolitical shadow, combined with the onset of the monsoon season in the southern hemisphere, is creating a logistical puzzle for iron ore and coal shipments. We are seeing iron ore futures rebound slightly to 790 Chinese yuan per metric ton as Chinese steel mills begin to restock, but the overarching theme remains one of high alert and diverted routes. Turning our attention to the energy sector, the narrative is being driven by a potent mix of heat and friction. Crude oil prices have extended their gains for a third consecutive session today. Brent crude is hovering near $69 per barrel, while West Texas Intermediate has advanced to approximately $64 per barrel. This upward trajectory is being fueled by two distinct engines. First, there is the escalating tension between the United States and Iran, which has traders pricing in a significant risk premium on the fear of supply disruptions in the Middle East. Second, the latest data from the Energy Information Administration showed a larger than expected drop in United States crude stockpiles, which fell by more than 2 million barrels in the most recent reporting week. This suggests that despite the broader economic headwinds we have discussed in past episodes, demand in the world's largest oil-consuming nation remains surprisingly resilient. However, the real shocker in the energy space today is natural gas. For the first time since 2022, natural gas futures have topped $7. A massive winter storm sweeping across the United States is the primary culprit, driving heating demand to extreme levels while simultaneously threatening production through freeze-offs. This price action serves as a stark reminder of how quickly the market can pivot when the weather turns. On the corporate side of energy, we are seeing a massive shift in asset ownership. Russia's Lukoil has signed an agreement with the United States investment firm Carlyle to sell its international portfolio of assets. This move, which still requires approval from the Department of the Treasury's Office of Foreign Assets Control, highlights the ongoing pressure on Russian energy giants to offload overseas holdings amid the current sanctions environment. Now let us talk about the headline grabber of the week, precious metals. If you thought the rally was over, the last 48 hours have proven otherwise. Gold and silver are not just rising, they are scaling fresh lifetime highs. In international markets, gold has officially crossed the threshold of $5,200 per ounce. Silver followed suit, surging 6% to nearly $114 per ounce. We are seeing a rare alignment of factors here. A weaker United States dollar, which makes these metals more affordable for international buyers, combined with a desperate search for safety as trade tensions and geopolitical uncertainty dominate the news cycle. It is a historic moment that reflects a deep-seated caution among global investors. In the base metals arena, aluminum is also making significant moves, rising to $3,308 per metric ton. This 10% gain over the past month is a direct result of tightening global supply and robust demand from the renewable energy and construction sectors. We are also seeing copper hold steady at around $6 per pound, reflecting its critical role in the ongoing energy transition, even as analysts keep a close eye on demand signals coming out of Asia. Speaking of the energy transition, the carbon and power markets are providing some fascinating data points. We have just learned that California's emissions under its cap-and-trade program fell by nearly 4% in 2025. While the rate of decline has slowed slightly, it shows that policy-driven decarbonisation is still moving the needle. On the international stage, Liberia has announced it will impose a carbon cost on shipping and aviation operators starting in March, a move inspired by the European Union's own emissions trading system. This is a clear signal that the cost of carbon is becoming a global reality, not just a regional one. Finally, we turn to the fields in the agriculture sector. Grains have had a mixed but generally positive couple of days. Soybeans have found support around $10.80 per bushel, while corn and wheat have also seen modest gains. Part of this strength is coming from the political arena, with recent comments from the administration supporting year-round sales of 15% ethanol blends. This has provided a psychological boost to the corn market. Meanwhile, in the physical market, we are watching Brazil very closely. While their soybean harvest is ramping up with strong yields, logistical bottlenecks and delays at export terminals are creating an opening for United States exports to fill the gap. In Argentina, analysts have trimmed crop estimates due to adverse conditions, further tightening the global supply and demand balance. It is a complex tapestry to weave together. We see a world where the physical movement of goods is getting more expensive, safe haven assets are being priced at a premium we have never seen before, and the energy complex is caught between a cold winter and a hot geopolitical climate. As we look ahead to the next 48 hours, the focus will likely remain on the Federal Reserve and any signals regarding interest rate shifts, which could either fuel or dampen this record-breaking rally in metals. As we wrap up today's deep dive into the commodities landscape, it is clear that the interconnections between geography, policy, and weather have never been more vital to understand. Whether it is the price of gas at the pump or the value of gold in a vault, the shifts we have discussed today will have a ripple effect across the entire global economy. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa, and thank you for joining me at the Commodities Institute podcast. I will see you back here tomorrow.